It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're taking a look at the real estate investment trust landscape, and I'm here with Vikram Malhotra. He is Mizuho Americas Managing Director and Senior Analyst. And so let's dig into the real estate investment trust universe. REITs, as they're commonly known. Welltower is the stock that you like here today. The stock's already done well over the past year. It's up about 61%. This is an owner of various senior care facilities, so it's sort of in the healthcare space here. Let's talk about why you like it. Demand accelerating. I guess this is a play on sort of the aging of the country.
That's right, and thank you for having me. So this is certainly the Silver Tsunami beneficiary, as they call it. The next 5 years, we're going to see the U.S. population grow 4 times the average, or the senior population grow 4 times the U.S. population. That's creating a wave of demand. Fewer caregivers means more people choosing senior living facilities. So we think demand grows at, call it 4+%, supply grows at 1%. You net those two together, you have a great occupancy tailwind for Welltower.
Well, and you also, I guess, have a good pricing tailwind, right? If there's not a lot of availability and there's a lot of demand, that equals pricing power on the price.
And it is interesting because pricing power comes in probably 2 or 3 forms. One is for the base rent or the houses that they live in. Second is the care component. You know, healthcare costs are booming, going through the roof. It's one of the things the Trump administration is trying to control, but costs are high. And the last piece of it is all the other services that Welltower is trying to add. They actually have a very interesting data analytics platform that they're using. It's very novel. They're trying to use to accelerate pricing, reduce capex. But yes, I do think there's a very, very strong pricing power tailwind as we go through into 25 and 26.
And Welltower, like many REITs, has sort of been a roll-up opportunity, right? They bought a lot of other companies. What kind of consolidation is still ahead of them potentially?
It's a great question. So if you look at the TAM, Welltower owns probably 10% of all seniors housing. But when you look at really what the quality senior housing footprint is, really the premium positioned senior housing, which is what Welltower goes after, I'd say they could probably 2x or 4x their footprint over the next 10 years if they choose to do that. Now, they'll probably be a lot more selective knowing how they are, but there's a huge market opportunity. So not only is there volume, but also using their equity as well as their debt, the spreads to their cost of capital is very, very lucrative.
So we always like to talk about what could go wrong, right? Or what's a potential headwind. In this case, labor costs, right? It's expensive to, particularly the care component, I imagine.
Exactly. Well, 60% of the operating cost for an operator that's a tenant of Welltower generally is labor. Labor costs have been sort of benign over the last year, but they were very elevated during COVID, especially temporary labor. So if labor costs go up, that's probably the one thing we do not have a great read. And if President Trump comes out and we have inflation or we have tariffs and that causes labor to go up as well, that would be the one headwind. I see Welltower, hopefully generating 20+% NOI growth or operating income growth. The one risk factor could be labor, which reduces margins, but also the overall story.
And one quick follow-up on the risk fund. What about ability to pay? In other words, there's a lot of demand, there's a lot of aging folks, but who's paying for the expensive housing and expensive care? It's
a fantastic question. So seniors housing in the US is private pay. The government is not funding, it's not Medicare, Medicaid. Typically, it's the wealthy senior or middle to upper income senior. The way they pay for it, they sell their home. So housing market being very robust is important for this. So you sell the home, typically you get proceeds, and there's probably a 2 to 4 year length of stay. But home equity and home sale is the primary driver of funding.
Interesting. All right, let's get to the stock you don't like as much, and that's Rexford Industrial Realty. This one, as the name indicates, is an owner of industrial properties, manufacturing, warehouses, distribution facilities, mostly in Southern California, right? So let's get to why you don't like this one. And this one's already fallen over the last year, and it has to do with geography. So talk us through that.
So we've actually had a negative view on SoCal industrial warehouses, and this company is exclusively focused 100% on SoCal. SoCal's probably had a couple of things. One, there was a great pull forward of demand during COVID. As you can imagine, everyone was ordering online. So a lot of retailers, tenants came in. 3PLs like UPS, et cetera, came in and took a lot of space. Now they're rationalizing. So that's number one. Number two, there's been a lot of supply, which has impacted the occupancy. And all of this has impacted pricing power. So I think one of the main things is demand was probably 10% of total available stock, which is very robust in the US, and it felt in negative territory.
Oh, wow.
And we don't see that inflecting in 2025.
And then there's also development lease-up minimal. You'll have to explain to us what we're talking about here.
So typically for a REIT, they develop properties. In some cases, Rexford in this case will buy a property, redevelop it, and hope for a better rent spread over time. Today, Rexford has about 4 million square feet of redevelopment lease-up potential. So which means as tenants come, they look to lease up a property. You can either go to a new development or redevelopment. And in this case, they have to make a lot of progress because they've invested the money, they've redeveloped the property. Now you need the tenant to come in and lease the space. So if that's very slow, which we think it will be, that's a headwind for revenue in the bottom line.
All right, and then finally, while we also saw our other pick have pricing power, this one does not necessarily.
Yes, I mean, so put in perspective, during COVID, over a 3-year period, you had rent growth in SoCal for warehouses go up 100%. Something that should have happened over 10 years happened in 3 years. As vacancy has gone up just from, call it 2 to 4% or 5%, rent growth has turned negative 25% this year. That means a landlord like Rexford has less ability to push pricing. They're seeing roll downs, and potentially in 2026, as that pricing power diminishes, there's probably going to be negative roll downs. That's why we're more risk, and that means the numbers, there's risk to numbers, both to the street, potentially to our numbers as well.
Gotcha. All right, well, let's talk about what maybe could go right here. We could see some kind of rebound in demand there, or maybe a reversal of migration patterns. So quickly talk me through this.
So I think it's a very interesting stock for the long-term investor. Somebody taking a 3-year view. It is truly starting to become value. But I think SoCal demand inflecting, particularly the large segments. Construction could be a boom in SoCal again. If we're rebuilding, that could be a near-term boom. But anything turning positive would be one. The second would be reversal of migration. And since 2016, you've actually seen resident population in LA actually migrate out, down towards the south, down to Texas, and that's impacted demand. As you can imagine, 50% of what's coming into SoCal from the ports is consumption-based. So we need reversal of both personnel, but also business formation.
Interesting. Really fascinating stuff. Thank you so much for being here.
Thank you for having me again.
And you don't own either of these stocks,
I do
correct?
not.
Okay, thank you so much.
Thank you.
Appreciate it, Vikram. And thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes at 3:30 p.m. Eastern. Stick around, much more market domination still to come.